Stocks are a little changed on this shortened week here. Taking a look at the major indices, about flat on the S&P, the Nasdaq just above the flat line at up about 0.3% here. But the S&P did hit a record high last week, despite some of the pullback that we've seen as of today. Our next guest does see more highs ahead. With more on this, we have Wald. He is Oppenheimer's head of technical analysis. Ari, thanks so much for being here. I know that as a technicals guy, you're always looking at the chart patterns. And in your latest note that we have here, you show a chart that has the S&P 50 and 200-day moving averages compared with NYSE's volume. What is the single biggest takeaway that we should derive from looking at those charts together?
Yeah, I think it's looking at the volume flows going into the recent price high last week, that what the volume line is capturing is that volume into advancing shares is outpacing volume into declining shares. So we view that as a sign that investors are accumulating stocks rather than distributing them. And typically that is a sign of a trend that should continue. It's viewed as confirmation. And so it's really just reiterating the point that we make, that the second year of this bull market cycle is intact. Investors should be looking to buy pullbacks in anticipation for higher market highs over the coming months.
And Ari, what are some of the technical trends that you're noticing here within the Russell 2000? Because you also make a case in a recent note just in terms of the fact that it is holding above its 200-day moving average, that is significant just in terms of the market participation that we'll likely see or are seeing.
That's right. If you think back to, and again, for us, the bull market started in the fourth quarter of 2022, but through the first year of that in 2023, it was very driven by large caps. And you really didn't see the Russell 2000 participate to as meaningful of a degree. And we haven't really had this broad-based breakaway in the market. Every time they're showing some signs of an everything rally, small caps pull back, and we're seeing some signs that could be changing. That one key difference between now and the action last year is that the Russell has been able to hold its 200-day average. It wasn't able to do that throughout 2023. So again, it hasn't been able to really sustain this breakout. But for us, that could just be a matter of time as we think about the second half of this year. You know, we want our clients to be embraced for what could finally be the broad-based breakaway in the cycle that we haven't seen yet.
When you look at the charts when it comes to the broadening out question, particularly with the Russell, are you seeing signs that it's driven by individual company news, or is it more a macro picture that indicates that there is a real hunger for a market broadening that could have legs?
That's a great question, where we have seen bottom-up dispersion widen to a certain degree. That there are stocks working in the small cap space despite the action in the Russell, and I think that speaks to it being held back by some macro issues, that being some issues in regional banks, which have really pressured our big component of the Russell 2000 and have pressured that benchmark. I think there's obviously the Fed cycle has a lot to do with it as well, again, those are all reasons why the Russell hasn't worked. And I guess, our point to investors, as we kind of think about what could be that catalyst for a move, is that absolute participation more important than relative leadership. What we have seen is this large cap led move to the upside. And I'm okay with that, but we do need small caps to participate in absolute price terms.
So Ari, it doesn't sound like you're seeing any signs of a market top now, and you're actually seeing higher highs here on the horizon. I'm curious, though, for investors out there who want to be prepared for some of the patterns or trends that they would see if a market was nearing its highs, what do you normally look out for just in terms of gauging whether or not we are approaching those high levels?
Sure. We have our market top checklist. What we'd be expecting to see are credit spreads beginning to widen. We expect to see the leadership of the market turn more defensive, and we'd expect to see internal breadth begin to narrow. And we really haven't seen any of that. And one indicator in particular we watch closely to suggest that we could be getting to that market top condition. It's an internal breadth metric. It measures the percentage of NYSE stocks that are trading above their 200-day average. And what we have found, looking at most of the major market tops over the past 20 plus years, is that there'll be a new S&P high and it's undermined by fewer than 60% of the NYSE above their 200-day average. And for that reason, we are encouraged that that current reading is coming off a level of 68%. So that is arguing against a market top. It would suggest that market conditions are stronger than that. And but conversely, it would be something we're going to be watching for looking ahead to suggest we are at that reversal point. Often that happens in the post-election year. In the third year of a bull market cycle, 70% of these uptrends typically make it to at least their 2-year anniversary. So with our indicators currently confirming the roadmap, all signs point to additional gains as we think about the balance of the year.
So if we're seeing additional gains ahead, I wonder if you still think the sell in May narrative is going to come true as we head to the end of the month this week. One of my favorite technicals phrases, sell in May and go away. It didn't seem to happen this year. Is that because of NVIDIA or is it because of just momentum breeding momentum? What is that?
Yeah, it's a strategy that we always talk about at this time of year. Something that no one has actually ever put to use. Nobody has ever actually sold every April 30th and bought back every October 31st. And there's some nuance to that as well. And sometimes we think about the 4-year U.S. election cycle and how that overlays with that type of strategy. And what we found that in an election year, specifically one with an incumbent candidate, typically that strategy hasn't worked. That you'll typically see a summertime rally. We came into the year showing that in an election year, a first-term election year, March to May is the weakest 3-month stretch of the year. But then that's typically followed by the best performing stretch of the year, June through August, which we're now entering in. So we are making the case that seasonals are a tailwind looking ahead, at least as we get into that June period. And so for all those reasons why we're looking to buy weakness and not sell in May and go away.
Ari Wald, great to talk to you. Thanks so much for your insight here this morning. Oppenheimer's head of technical analysis. Thanks again.
Thank you.